Good afternoon, fellow traders. Thank you for joining to another webinar in the Blue Sky Forex webinar series. Before we move any further, can you just tell me whether you can properly hear me and see the presentation screen? All right, thank you very much for the confirmation. I do apologize for the small delay in starting up the webinar, but we're here now and we are ready to go. So today's topic will be volume weighted moving average, VWMA in short. And while we let the last people connect, let me just go through the disclaimer quickly and then we can kick this off. Contents of this material are provided by third party, not Hot Forex, and are for informational purposes only and do not constitute investment advice. Hot Forex and Blue Sky Forex assume no responsibility for any potential errors, inaccuracies, or omissions in this material. Nothing in this communication contains or should be considered as containing an investment advice or an investment recommendation or solicitation for the purpose of purchase or sale of any financial instrument. Any views or opinions presented within this material are solely those of the author and do not necessarily represent those of Hot Forex unless otherwise specifically stated. Currency trading may not be suitable for oil investors as it carries a high degree of risk to your capital. Trading such products is risky and you may lose all of your investment. Past performance is not indicative of future results. Poor fill rates, expiry times, market volatility, and platform errors could result in losing trades. Before deciding to invest in currencies, you should carefully consider your investment objectives, level of experience, and risk appetite. You should be aware of all the risks associated with foreign exchange and currency trading and seek advice from an independent financial advisor if necessary. So with this out of the way, I will first of all quickly introduce myself. Then we will briefly take a look what is volume weighted moving average, when can you use it, and then four different ways what you can do with the volume weighted moving average. And of course, then at the very end, you can ask your questions. So please write them down and I will do my very best to answer them. If some of your questions remain unanswered, then don't hesitate to send an email to webinars@hotforex.com and they will do their best to provide you with an answer instead. So I am one of the senior traders here in Blue Sky Forex. We are a research, an education and trading group. We teach various different strategies. We do also provide 24-hour trade support and analysis just to help retail FX traders to make better trading decisions. Blue Sky Forex is presenting this webinar on behalf of Hot Forex in order to educate you and help you become highly profitable currency traders. So what is VWMA? It's the volume weighted moving average, and its movements and its calculations emphasize on the actual trading volume of the asset, and it is weighting its prices based on that trading activity on a given period of time. So when an asset sees a lot of movement, a lot of trading volume, then a lot more pressure is put onto the moving average movement, okay? And when there is less volume, then less pressure is put onto the actual moving average movement itself. And this means that the volume weighted moving average behaves quite similarly to a simple moving average when there is low volume on the asset that you're observing. Okay. Now, if the volume goes higher, then it will show you a bit of different moves than the simple moving average. Okay. And you can use this difference between the simple moving average and the volume weighted moving average to your benefit, just to help you determine what the price might be doing next. Okay. Especially the crossing of the simple moving average and the volume weighted moving average. We do have a different webinar as well where we discuss more about the ways you can use the moving average crossovers between each other, like the exponential moving average, simple moving average, and slower and faster moving averages. This is essentially it's a similar thing. You are still observing crossovers between the simple moving average and volume weighted moving average, but generally speaking, you would be using the same period. Okay, so I will show you also a few ways on the on view examples how you can utilize this as well. Okay, like any moving average, volume weighted moving average is also often used in combination with other technical indicators, and of course, a lot of different ways you can use a simple moving average or the exponential moving average. All right. Now, when is the best time to use the volume weighted moving average? There is really no restriction. There's really no best time. You can use it on any asset class. You can combine it with other indicators. You can use it on any chart time frame. You can use it to help you identify a forming trend or a breakout. So essentially, all the same characteristics apply to a volume-weighted moving average as they apply to a simple moving average or an exponential moving average. It's just a moving average, right? But just a small tweak to it. And interestingly, the volume-weighted moving average is also it is by many considered a zero lag indicator, but I personally consider all the moving averages lagging indicators because this is simply how they are calculated, right? So some of them might be more sensitive to the current price movements, like the exponential moving average. Some of them are more sensitive to the volume of the price of the asset, like the volume weighted moving average. There are a lot of different moving averages out there. I personally think they are still lagging, but many consider this one as a zero lag indicator. And it is said that this indicator is quite often used by large banks and hedge funds as well. Okay, very interesting, right? So let's take a look what this is all about. So four different ways how you can implement volume weighted moving average and then its benefits. You can take it to help you discover emerging trends. It will help you discover or understand or realize current trends. It will be able to help you find the potential end of a trend. And there is also this volume weighted moving average divergence between the price and the combination of moving averages, what you can observe on the chart. Anyways, let's get right into this. So just to help you discover the emerging trends. Now, one thing to note here that the simple moving average, this is the red one, if you can see on the screen here on the image. The red one is the simple moving average, and the blue one is the volume weighted moving average. They have both the same period. Okay, they're both have a period as 30. So let's just take a quick look here. Just ignore the cap. We will pretend that there was, you can still properly see the price here, just for the sake of the example. You have the ranging market here under the envelope, on the square. And as soon as the price really starts gaining a lot of volume and starts going in one direction, you see the volume weighted moving average pulling away from the simple moving average quite significantly. And this is what you would be looking for when comparing the simple moving average and the volume weighted moving average. Okay. So you will be looking at the volume weighted moving average just gaining distance from the simple moving average. I mean, it is simple as that. Okay. They're still both moving averages, just the volume weighted moving average is based on the actual volume of the asset and the price movements. So if you are okay, let's take this is somewhat related to the very first way or first point how you can utilize this. So when you have a trend forming and when you have identified a trend forming based on the volume weighted moving average and the simple moving average, it's in a similar way as you see the relation between the simple moving average and an exponential moving average, for example, right? The exponential moving average is more sensitive to the current price movements than the simple moving average is. Thus, you will see exponential moving average all quite often moving ahead of simple moving average in the direction of the price. So the volume weighted moving average during a trend, it behaves in a similar way. Uh, in order to determine whether you can properly benefit from the relation of the volume weighted moving average and simple moving average, and you see the trend forming, thus the volume weighted moving average is between the price and the simple moving average, then you can look for the trading opportunities along with the trend. One of the ways is when the price actually reaches the moving averages and then continues along its path. Just a small pause or just a small test to the moving averages as they serve as support resistance levels during the trend, right? The price never moves in a straight or linear line, it always moves in waves. So you can trade along with the next impulse wave along with the direction of the trend when the price is testing those moving averages. One thing to note here is that the volume weighted moving average still should be in the direction of the trend from the simple moving average. So between the price and the simple moving average. Okay. Now, when the volume weighted moving averages they touch the simple moving average, then you have to be careful because you might have a larger correction happening, or you will just see the price volume consolidating. And the consolidation usually means that you will have a breakout upcoming shortly, right? And the breakout can actually happen in both directions. So when your volume dies down, if you see the consolidation in the price, then wait for a moment and see what the next move will be. If the next move will be still in the direction of the trend, which it likely is, then initiate your trade and trade along with the trend and the direction. Okay? And again, when the volume weighted moving average moves above the simple moving average, away from the actual price, again, wait for what the price is doing next. Okay? And when the volume weighted moving average moves again past the simple moving average and between the price and the simple moving average, then it indicates the trend is continuing and you can trade along with it. Okay? If the volume weighted moving average really starts moving really close to the simple moving average, that means that the volume is becoming lower, and you should really be careful and really closely observe what the price is doing. Okay, because you see here at the very end that the volume weighted moving average, it did move above the simple moving average, and after this point it kind of stayed level with the simple moving average and didn't really move between the price and the simple moving average significantly. It didn't gain enough distance, so you should be really careful at this point already. Okay. The next point would be, again, a bit related to what I explained on the previous slide. You have enough distance between the simple moving average and the volume weighted moving average. You have a trend forming, right? So you see a large gap between those moving averages here. And as explained before, when the volume weighted moving average goes back to the simple moving average and stays there for a quite considerable amount of time and doesn't really gain enough distance again from the simple moving average, that means that you will most likely be nearing an end of a trend. Okay, so you should be looking for exiting the trade at this point. Okay. So the fourth way or method how you can utilize the volume weighted moving average would be a divergence between the price and the combination of volume weighted moving average and simple moving average. Okay. Now a divergence, sure, this is not an oscillator, the moving average, but you can still observe the divergence between the combination of these two moving averages and the price. Okay. Okay, so if you witness an upwards trend, for example, for some time, and you see the price still making higher highs, but the volume weighted moving average is already consistently moving below the simple moving average. Okay, so you would be expecting the price actually, moving on the other side of the moving averages already, but it's still, forming higher highs to some degree. Then this is already a hint that the price reversal is coming up. Okay, when the volume weighted moving average is moving on the other side of the simple moving average, considering the price, and then the volume is dying down. Okay, but if the price is still making higher highs despite the volume dying down, then it is a clear indication that price reversal is coming up. Okay. Quite, I hope that made sense. So price making still higher highs. If you remember on the webinars where we discussed the divergences between the indicators, you will definitely remember the divergence between the price and the RSI, for example. This is a very easy divergence to read when the price is making higher highs, but the RSI is showing you lower highs. Okay, so that's the divergence between the price and the RSI as the indicator. And then it's a clear indication that the price reversal is coming up. Okay, now here you will not be dealing with one single line where a single oscillator can make either lower highs based on the price or higher lows. You will just need to compare the relation between the simple moving average and the volume weighted moving average and what the price is doing. Okay, so if the price is still making higher highs, but the volume weighted moving average is moving below the simple moving average on this occasion when the price is going higher, then you have a divergence. Okay. And here you see the result. This is the same chart, the same move, right? And at this point, you have identified a divergence between the price and the combination of moving averages. And this is the price reversal happening already. And you can easily witness what's going on. All right. And obviously, everything that showed an example as an upwards trend, it works the same way in a downwards trend. Okay, so vice versa, it works the same way. Just for you to keep in mind. So essentially, just to conclude the difference between the volume weighted moving average and the simple moving average is simply the volume of the price. Okay, if you see the asset gaining volume, then you will see the volume weighted moving average gaining sensitivity, and it is moving more sharply. Okay, and then the whole idea how you can really get your head around it is obviously when the price is gaining volume, you see the price moving up and down more significantly, and you will more often witness significant moves up or significant moves down. You will not see a lot of these battlegrounds, and you cannot really utilize the simple moving average and volume weighted moving average combination on a sideways market if there's a lot of volume, right? Because the volume weighted moving average is simply really frequently moving up or down based on the simple moving average, right? If you see the price moving a bit in one direction and you see the volume weighted moving average really moving away from the simple moving average, and you see the next candle also moving in the same direction, then obviously the volume weighted moving average gains distance from the simple moving average, and you will see the price starting to move quite often in one single direction, okay, and gaining strength and starting up a trend. You can also consider using volume weighted moving average exactly like an exponential moving average and simple moving average combination. Okay, there are a lot of different strategies that you can find online, or a lot of different ways how you can combine the exponential moving average and simple moving average together, and then find trade entries like that. You can, if you want, also use different periods for the volume weighted moving average and the simple moving average and use it like that, as a slower and the faster moving average, and find entries like this. This is also an option. You will just see volume weighted moving average giving you a bit more immediate trading signals than or perhaps more reliable trading signals than an exponential faster moving average would. Okay, so that also might be the reason why it is said that big banks and hedge funds are using the volume weighted moving average quite a lot. They of course use this to have the moving average consider the volume of the asset as well, because it combining with the volume at the bottom of the chart, it will help you analyze the price movements better. Okay, so all in all, just take it with a grain of salt. This is still a moving average, just a small tweak to it. It will help you incorporate the asset, the volume, when you are making your trading decisions. Okay. One thing to note here as well, that the volume weighted moving average is not available by default in the MetaTrader 4, so you might need to find this online and download it manually. and then add it to the MetaTrader 4. Now, another thing to note is that depending on where you download it, some of them might be buggy, might not really work or show the actual values. So you need to just, I don't really have a proper source to suggest where to download one, but the MQL5 website should provide you with a proper volume weighted moving average to download. So you can check it out from there, okay? Now let's also quickly go through the currency trading dangers as per standard. Please do not trust trading bots or any automated mechanism or system that trades in behalf of you on your account. Okay, most of them are designed to generate losses in your trading account, so please be careful. If you want to test out one of them, please simply use a demo account and see if you are able to consistently grow your demo account capital throughout an extensive amount of time, like 4, 5, 6 months maybe, okay, and without large drawdowns. If so, only then move it to a live account. But if you do, then please use low lot sizes, because the lower you go, the safer you are, okay? Most of these bots, they will not be able to remain profitable in all market conditions, and in some cases, when the market conditions are really not favorable for that certain automated system, these kind of conditions can remain or last for a long time. So that certain system can really easily empty your account. Okay, so please be careful. Now, sad but true, but only 5% of the retail traders make money in FX in the long term. And the reason behind this is it's really simple. It's in our human nature, it's part of our psychology. When we win a lot, we get adrenaline released in our brain. We feel invincible. We want to win more. And eventually we become inadequate to analyze the proper chart movements, make silly mistakes, and either lose all our profit, make some losses instead, or just empty our accounts. Okay, this is called overtrading. Okay, we do tend to overtrade if you don't set our rules. On the other side, if we lose, if we are on a losing streak, then there is different kind of chemicals released in our brain, which again makes us animalistic, and we are again unable to properly analyze the price movements, and we start making silly mistakes and generating even more losses on our account, or just simply emptying our account completely. This is called revenge trading. So if you lose a bit, you want to take the revenge on the market and want to earn back that lost amount. Okay? Both of these scenarios are dangerous, and this is generally the reason why most retail traders fail. Okay? Which brings me to the next point. If you, so to speak, blow up one of your accounts, that means they completely empty one of your trading accounts. It happens, right? It's not necessarily a bad thing. It is a bad thing, but it's not necessarily the worst thing that can happen. The thing is that when this happens, it's essentially a lesson, and it is telling you that you need to change something. Okay, you need to change a part of your strategy. Something is not really working out, and this is the reason why you managed to empty your account. So this is generally part of every trader's journey. I'm quite sure that most, if not all, professional traders have been there in the past when they were starting out. They have emptied one or two accounts. And what they did is they remained persistent. They educated themselves. They changed part of their strategy. They changed the way they are trading. They improved, and thus over time they became consistently successful. So when being there, right, when you just have emptied one or two accounts, and you decide that you want to succeed, you will be persistent, you want to work this out, then as I mentioned, you have to change part of your strategy. Really important is not to completely change your strategy and start jumping from strategy to strategy just to find the one that suits you best, right? Just browsing online forums, trying or testing out different strategies that other people say that works out for them. It's not really the best way how to become consistently profitable. Okay, you need to change a part of your strategy that you have tailored to your own trading habits. Okay, ultimately strategy will be something that consists of your money management, your risk management, the combination of technical indicators that you use, sure, what session you are trading in, how long are you trading per session, how many trades you are initiating, what are the lot sizes you are using, what are the assets that you are trading. All these kind of bits and pieces make up ultimately a strategy, and this strategy is unique to you. Okay, this strategy needs to be tailored by your trading habits and your trading style, whether you be a scalper or a day trader. Okay, now you need to change part of it. If you're failing, then maybe it's not the right session for you to trade. Maybe your trading mentality does not really collaborate the characteristics of that certain trading session or that certain market type. For example, if you're trading during the end of the US market and you see very low trading volume, okay, you have little volume on the market, but your trading habits and your style actually expects high volume of the market. Obviously, you will not see yourself being successful. Okay. Now, how to really find out the weak link in your strategy? Such a thing called as a trading journal will help you out with that. Okay. So what you can do is after every session, just take 10, 15, maybe 20 minutes to analyze what have you been doing during that certain session and just document it down and keep a journal, session by session, how many trades you initiated, what were the assets that you were trading, what were the lot sizes you were using, what were the conditions why you entered those certain trades, well, what made you enter the trade in the first place, what were the conditions, and all those bits and pieces, as many details as you can, just document them down, because this will ultimately help you analyze your own trading habits. It will help you analyze your own trading techniques, and ultimately at the very end you will find what works for you and what doesn't work for you. Okay, for example, let's say that during one single trading session you manage to initiate, let's say, 1 week, and every day you traded during the business hours, right? And although on those 5 days, every session you initiated one trade, and at the very end of the week you had made 100 pips of profit. You take the next week, every session you initiated 5 trades, but you end with a small loss or at equal balance. So this already shows you that when you initiated less trades, you managed to earn some profits. When you initiated more trades, you managed to either lose a bit of money or stay in balance. So this already tells you that you are initiating too many trades. If you initiate too many trades, it doesn't work out for you. Okay? If you initiate less trades, you perhaps put more emphasis on that single trade just to get that right. You maybe spend a bit more time analyzing the trade and the conditions that you are in at the moment, and you will make better trading decisions, right? So this is just as an example that keeping a trading journal will help you do, right? It will help you analyze what you are doing on the market when you're trading. So definitely keep a trading journal. Trust me, it will be beneficial to you. Okay. The next point here is only 5% or even less all the signal services and rooms are legitimate. So please be extremely careful when engaging in one of these. Before using any of these, please make sure that you check their performance record and audit trail. If possible, ask for experience from other traders, how they have been able to utilize that certain signal service or signal room, and see if they have been successful throughout an extensive amount of time without large drawdowns. If so, then set it up on a demo account at first. Use low lot sizes. If this works out, then only set it up for a live account if you want. Again, use low lot sizes to just stay safe. Okay. Actually, one last thing that is not on the slide here that I still want to stress the importance of is that you don't have to trade alone. Okay, you might consider yourself, a lone wolf that does everything by him or herself, and this works out for you in normal life. Fine. But when it comes to trading, and if you are engaging the markets alone, if you're just trying to uh, seem powerful and tell yourself that you have a lot of strength and you know what you're doing and then you're smart, uh, fine, but it will really slow down your, how to say, it will really make the journey to being an advanced or a professional trader longer. Okay, you don't have to, make all mistakes yourself per se. What you can do is just look up different trading communities, even different, forums or chat rooms will work. You will see a lot of different traders, beginners, intermediate, and expert traders usually using those, communities as well, just to share their own experience or ask for advice. What you can do is you can share your trading journal with others. They can actually take a look, tell you what they think. Maybe they can notice something that you are potentially doing wrong. They can provide you with a really critical and useful feedback, and you should really utilize those um, communities just to gather information, gather feedback about your trading habits, and also before entering a position, you can also uh, engage that community just to tell you why you would enter that position, and they can tell you if they think that's a smart idea or not, right? Maybe an expert will actually respond to you and tell you why it's not really smart to enter that position. Obviously, you don't have to do everything the other traders tell you. That would be moronic. You still have to make the ultimate decision yourself. But listening to others and gaining and gathering feedback and information from others is really, really beneficial to your own evolvement. Okay, a lot of critical feedback will most likely be provided to you, which you should really utilize and take it on board when you want to move further. Okay, so it's something really, really important, and I would say that this is really useful, so to say, tool in your arsenal if you have access to one of these communities. Okay. So this is it for today's webinar. It's just a simple overview of volume weighted moving average, what it is, a few different ways how you can utilize this. If you have any questions, then please, now is the time. Just write them in the question section. I'll pick them up and I will answer them as we go. Okay, just give me a moment. Let me open up the question section here. Tulani, the webinar started right 44, actually a bit less, 41 minutes ago, so 3 minutes after the full hour. So you didn't miss out too much, don't worry. You can find all the recordings of the past webinars when you go and log in to your Hot Forex account. Find the education section where you see the list of all upcoming webinar topics and the dates. And there you will find the link to past webinars. And that page will include all the recordings of the webinar, different webinars that you can just click on and review later on. Raya Murali is asking how to add volume-weighted moving average to MetaTrader 4. Is it available on the trading tool section at Hot Forex? It should not be available on the trading tool section, and it also is not available by default in the MetaTrader 4. So you do need to find one online. There should be one available on the MQL 5 website, the official MetaTrader website. In the technical indicators, you can just type in a volume-weighted moving average download for MetaTrader 4 in the Google search, and you should come up with a few results which you can utilize. Just download it, put it into your indicator folder of the MetaTrader 4 program, and then you can add it to the price chart the same way you add any indicators. Yanusa is asking, can you please give a few examples of any recommended chat rooms? I do apologize on this webinar for legal and regulatory purposes. I cannot give out any recommendations of any third-party services that allow you to engage with any communities. However, trust me, if you look online, Forex trading communities or something similar, you will definitely come up with a few sites, few maybe chat rooms or etc. that will that you can engage with. Okay. Solomon is asking any advice on any of the setups for the simple moving average and volume weighted moving average. Well, essentially, the four ways that I showed you earlier, those methods are using the same periods between them. Simple moving average and volume weighted moving average have the same period. And just observe the volume weighted moving average moving in a certain direction along with the price and between the simple moving average and the price. This indicates a trend. Another way is how you can utilize the volume weighted moving average and simple moving average combination is similarly to an exponential moving average and a simple moving average combination. When the exponential moving average is moving away from the simple moving average, and also the price is going in the same direction, you can consider a trend forming. And when it goes back to the simple moving average, you consider your trade exit or the trend exhausting, and so on. You can utilize this just in any way how you would utilize different combinations of moving averages. You just have to consider the fact that the volume weighted moving average is really becomes more sensitive when there is more volume on the observed asset. Okay, and this will give you a bit of a benefit, because if you are trading along with the direction of the trend and you see the volume increasing based on the volume weighted moving average, then you will potentially catch a larger or more significant or more stronger price movement. Okay. Habib Ravani is asking, what is the difference between volume weighted moving average and moving average 200? Okay, the 200 at the moving average that you state is the period of the moving average, right? Every moving average has a parameter that you can define, that is the period, okay? And the period defines how many candlesticks back the calculations are taken from, okay? So volume weighted moving average will also have a period, and if you set it to 200, then at the times of low volume, you will see the volume weighted moving average and the simple moving average with the same period being quite or seeing the identical movements. There's really no difference between uh, the periods if you set them on different moving average types. Just the volume weighted moving average is more sensitive when there's more volume on the asset. That's the difference between simple moving average and volume weighted moving average. Faraz is asking, can we sign up to live trading room on Blue Sky Forex? Yes, of course. Just search uh, Blue Sky Binary on the web, and you will find on the website. I can just take it from there. There's a Skype room as well where you can discuss all these kind of things. Abram is asking, what is your take about Auto Chartist, the signal provider? Can I use it? Um, I'm really sorry, but I can't really comment on any third-party providers. I haven't used Auto Chartist myself anyways, so I can't really provide any recommendations based on my experience. But in overall, I can't really provide any comments on any third-party services. I'm just, saying in general that you should definitely uh, do a background check if you want to use any signal providers that just tell you what assets to trade or give you recommendations or suggestions what assets to trade. Definitely ask for a performance record. This is extremely important. Okay. And yeah, just an audit trail as well. Possibly ask for any feedback from any other traders that might have used that service provider in the past. Okay, there's a question, what was the value of the moving averages? Okay, you most likely mean the period. On the examples above, in most cases it was 30. So 30 was the period. Solomon is saying, uh, does using the same period of simple moving average and volume weighted moving average will work on any time frame? Yes, you can use moving average in overall on any time frame you want. Okay, this also goes for any different combinations of moving averages, any different periods of moving averages as well. Tulani is asking, what is the difference between exponential and simple moving average? Sure, the exponential moving average is simply more sensitive to the immediate price movements than the simple moving average. If you add both of them on the chart with the same period, you see a lot more sharp movements by the exponential moving average and the simple moving average. And this is quite a popular combination when just attempting to catch the trendy movements, attempting to trade along with the next impulse wave, and helping identify the potential reversals of a trend or endpoints of the trend as well. Okay, and the volume weighted moving average obviously can be used in the same way, but it will just be more emphasized on the actual volume of the price and potentially a bit better entries, perhaps. Yunus is asking, can I use, for example, a simple moving average with period of 200 and a volume weighted moving average with a period of 100? Of course, you can use it. That would be like using a slower moving average with a faster moving average, again, to help you determine the general direction of the trend. And when you use these high period values, then you will simply able to determine the larger scale uh, directional move of the certain asset, right? When using these high periods, then you cannot really use them to pinpoint a shorter term trade, for example. Raya Mural is asking, isn't exponential moving average and volume weighted moving average almost the same? Not really, they're not almost the same. Um, Exponential moving average is simply more sensitive to the immediate price movements than the simple moving average is. Volume weighted moving average is like a simple moving average when there is really low volume. It has relatively identical movements, and it becomes more sensitive when the price movements gain volume. Okay, so it is still a different thing. You cannot really compare them too much together. Okay, we do have 3 minutes remaining, so last call for questions. Okay, seems that there is no more questions coming in. So from my side, I hope that today's topic did help you to understand what is the volume weighted moving average about, gave you a bit of insight, a few methods how you can potentially utilize it. Obviously, if you want to try it out, do so on a demo account. Don't jump onto a live account immediately and start, observing or making trades based on the volume weighted moving average and simple moving average combination, or any combination with the volume weighted moving average. Just trade safe always. And from my side, thanks really much for joining today. It was my pleasure to be the host, and see you next time. Take care, everybody.